financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist and best-selling author. Here's Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. And as you heard, my name is Jerry Robinson. I'm an economist, author of the book Bankruptcy of Our Nation, and founder of followthemoney.com, a financial education website that focuses upon helping people become better traders and better investors. We've created our own trend trading system that we've been using for years, even back in the 2008 economic crisis, that has helped us navigate the markets. And if that's what you're into, if you're interested in the markets, financial markets, whether it be stocks, bonds, commodities, cryptocurrencies, real estate, that's what we like to talk about here on this podcast. So today's episode is episode number 428, and it is entitled 2022 Market Recap. So in this episode, we're going to be taking a retrospective look at the major trends and movements of the financial markets in the year 2022. We're also going to analyze the performance of some of the key indices, identify some of the top performers and laggards, and discuss a sector breakdown of the stock market here in the United States. So we'll be talking about stocks and bonds and commodities and cryptocurrencies. So before we get into the details, let's kind of set the context here for our discussion by just taking a look at what 2022 looked like with an economic backdrop. So in 2022, we saw the payback for what we would call the excessive amount of money printing that we saw in 2020. Remember back in 2020, amid the COVID-19 outbreak, that the United States, back in March, we saw the stock market really implode. It was followed by the Federal Reserve lowering interest rates dramatically all the way down to zero, and then pumping in the most amount of money that has ever been seen in world history. No one has ever seen this kind of money printing that we saw in 2020, and that actually continued into 2021. So many people think that we should have gone through a longer recession in 2020 instead of the very brief, recession that we did actually experience in 2020. So we had all this money printing that occurred in 2020 and then in 2021. And of course, the Federal Reserve waited too long to begin draining the economy of all that freshly printed money. And so when price inflation did begin to appear back in 2021, the Federal Reserve delayed. They delayed, taking action until March of 2022. That's when the first rate hike actually began. And they called the inflation, quote unquote, transitory. That, of course, has become a joke now in retrospect, as the inflation went on to go very, very high and really complicated the entire economy, not just the United States economy, but the global economy. Even back in March of 2021, just as inflation was really beginning to be noticed, U.S. Treasury Secretary Janet Yellen said that inflation only posed a small risk. So it wasn't just the Fed, it was the Treasury as well, the U.S. Treasury, that just didn't get it. Now, we were talking about inflation way back on episode number 389 of this podcast. We had a podcast episode called "Inflation is Here," and I was explaining batten down the hatches, here it comes, because you can't print all of this kind of money and then leave it like that with the kind of backdrop that we had in 2021, 2022, and not see the acceleration of price inflation. So now many people don't understand why the Fed is hiking rates. And this is because a lot of people, quite frankly, guys, they just don't really understand what inflation is. We don't learn too much in school and when it comes to economics. And many times, even the things we do learn in school about economics are either poorly taught or they're poorly apprehended, or sometimes they're just flat out wrong. And just a real quick 101 here on why inflation and interest rates work the way they do. And I've told the story many times, but money flows to the rate of highest return. And so if you raise interest rates, What that does is it sucks out money out of the general economy, out of circulation, so to speak, and into the banks where they can earn that interest. So we've been seeing that in 2022 as more people have been taking cash and they've been taking it down to put it into a CD or a money market or something that's actually paying something, or maybe even into bonds, which got hammered, of course, in 2022. And so you have people who will take money and they will take it off the sidelines. In fact, banks are less likely to loan money if they're able to earn a fairly high, or stable interest rate on it. So it slows down the overall velocity of money, so to speak, and it also really causes people to put money away. And when you put money into the bank, that is a way of slowing inflation. This is a very crude way of describing it, but it's quite simple. And then, of course, when you lower interest rates, then people are more apt to borrow, they're more apt to spend, they're more apt to, move, and businesses do the same thing. So that causes more economic activity. And what the Fed was trying to do was to slow down economic activity because it was fostering inflationary pressures. And so that's why the Fed, needed to raise interest rates. And at some point, the Fed is going to reach a level, we think that terminal level is going to be about 5%, where they're going to turn around and say, okay, well, now it's time to pause, which we think we're very close to. We would expect to pause sometime in Q1. And then they're going to pivot to rate cuts, right? So we're going to go through the whole cycle here where we've been through this crazy, zany rally in interest rates. But then it's going to turn right back around and it's going to begin to be cut over time. So that pivot, will likely come at some point in 2023. And that will serve as a tailwind, of course, for asset prices, especially stocks. And especially, we would say there's several different areas that we could probably get into, but let's continue our discussion here. So when we look at the official U.S. inflation rate, or the CPI as it's known, that peaked back at 9.1% in June. That was the highest level we had seen in 40 plus years. And since that time, it's been on the decline every month since. So the CPI actually eased for its fifth consecutive month to 7.1% year over year in the month of November. That was down sharply from October's 7.7% rate. And November's 7.1% CPI print was the lowest official year over year inflation print since December of 2021, which was about 7%. So while just a few economic data points don't make a trend, we now have clear evidence from the prior 5 months of data, inflation data, that the Fed's aggressive rate hikes are having their desired effect as official inflation here in the United States continues to cool at a steady pace. And we would hope so, because we just suffered through the fastest rate hike campaign in our lifetimes. The Federal Reserve raised its benchmark federal funds rate at the fastest pace ever in history, with 7 interest rate hikes through the course of the year, bringing the effective rate to a range of around 4.25 to 4.5, up from 0 in January. So let me explain what that means. That means that the effective federal funds rate was 0.08% on January 3rd, 2022. Okay, 0.08. It's practically 0%. On December 29th of 2022, at the end of the year, that effective federal funds rate had been lifted, I should say, to 4.33%. Now that's a 5,300% increase in the effective federal funds rate in just 1 year. So if you're wondering what just happened to the stock market as you look back at 2022, you open up your 401k statement or your IRA statements and say, what was 2022 all about? It was about the fastest increase in interest rates that we have seen. This is simply shock and awe kind of response from the Federal Reserve, even though the numbers aren't that large, even though we didn't see the interest rates go to 20% or so like we did back in the Volcker era. We still saw a very quick ascent. It was so quick and sharp. And the reason why it was so fast, quite frankly, was because the Federal Reserve admitted that they dropped the ball. They should have been, tackling this much earlier, and they admit this. But instead, they had to play catch up because they waited so long. So they had to raise interest rates real fast all in 1 year, right? So that explains why we've seen the big sell-off, not only in stocks, but also bonds and other things. And in some ways, you would think to yourself, well, if you raised the effective federal funds rate from practically 0 to 4.5, you would expect perhaps in 1 year, you would expect perhaps to see even more of a sell-off. So in some ways, you could build the case that the markets were a bit more resilient than some people had expected. Now, let's talk about some of the major trends and movements in the markets. This was a year for the record books. There were very few places to hide. And our trading system, we have a trend trading system here at Follow the Money. It's called the Profit Tracker Trend Trading System. Our members use it every day. It's a very powerful system that allows you to type in any stock, any ETF, any cryptocurrency, any index, any global stock, and you can immediately detect the trend in that stock and know whether it's entering a new uptrend or entering a new downtrend. Well, our trading system detected a major downtrend alert in the S&P 500 and the NASDAQ 1 year ago in January of 2022. There was a new position downtrend that we alerted our members to through our weekend trends report. We call the Robinson Report, which, by the way, if you're not subscribed to our Robinson Report that we put out each weekend by email, it's a PDF and also a video. You've really got to get that. If you're into the markets, you're into trading or investing, it's very helpful. It gets right to the point, cuts right through the noise, and gives you exactly what you need to know about all the major markets and what we're watching and new uptrends and downtrends and whatnot. But when we look at what happened last year, our system confirmed a new position downtrend alert in the S&P and the NASDAQ 1 year ago in January, and then it confirmed a new long-term downtrend about 5 or 6 months later. So we alerted our members to all of this, again, through our weekend trends report and through our coaching calls and all of this. Now, what was going on in 2022 was quite wild. Aside from the fact that we had a Federal Reserve that was, raising interest rates at this rapid pace, we had a war going on in Ukraine. A devastating war that still doesn't make sense to a lot of people and is still highly controversial as to what actually is going on and what's true and what's not. That old saying by Aeschylus that says that, in war, truth is the first casualty. Well, that's certainly what we've seen in the Ukraine war. But the Ukraine war, of course, involved a power, Russia, that was a major oil power. And so oil prices, they skyrocketed in 2022, nearly $130 a barrel at its peak. And then, of course, the invasion of Russia into Ukraine limited the amount of supply of oil. And over time, throughout the year, we began to see oil come down, oil now kind of moderating in the $70 to $80 range. So you had that situation going on. And then you also, in Europe and its energy crisis, that was a really big theme of 2022. And then you also had another theme of 2022, that's China's economy, which was closed. I mean, the Chinese economy for the last 3 years has practically been closed. Very little mobility, very little movement, extreme zero COVID policy measures, which after some protests, and they were relatively small, to be honest, maybe relatively big compared to one we've seen in the past. They certainly got a lot of news coverage in the West as normal. But in China, they are now reopening their economy. So Beijing has committed to promoting the economy and boosting the economy now that the economy has been closed for so long. They're reopening it, changing their approach to COVID. The COVID numbers in China expected to go up. However, China is just simply changing its strategy. And as China reopens, we just don't know what this means, but I have a feeling that it's going to be pretty important. We haven't really lived through a time where the second largest economy in the world on a nominal GDP basis actually closes down and then reopens. So we've had some wild, crazy times over the last 3 years. And now that China's reopening, what does that mean for the global economy? Well, we don't have time to get into that particular theme, but that's a really good question that we ought to be thinking about. What's that going to look like throughout 2023? We think it's probably going to be better than some analysts are expecting. We'll just see. Also, we had supply chain, issues spilling over from the pandemic. We had lots of supply chain issues due to the Ukraine war, that being the breadbasket of Europe. So we had supply chain issues with China and all of this. And then you had another major theme, which was the U.S. dollar. That started off the year really well, and it rose to its highest level in around 20 years by Q3. The dollar began to weaken in Q4 of 2022 because inflation was coming down. And now most investors believe that inflation has peaked, and that's not as bullish now for the U.S. dollar. The dollar kind of moves in tandem with interest rates. And so if interest rates are expected to generally decline over the coming years, then we would also expect the dollar to follow along in tandem, barring any kind of unforeseen circumstance. And then we also have the backdrop in 2022 of Treasury yields, like bond yields here in the United States of all maturities, whether you're looking, all across the yield curve, they all surged in 2022, especially short-term yields. And the 2-year Treasury yield rose to 4.3%. It was below 1% in January of 2022. The 10-year yield jumped from 1.5% at the beginning of the year to about 3.8% by the end of the year. So, that was really quite a move. Now, we haven't seen the 10-year above 4% in some time now, but when you see the 10-year above 4%, that's a lot of pressure there on the economy. It's a lot of pressure on interest rates for mortgages and other things like that. Now, let's talk about some of the major market indices. Let's talk about, like the S&P. The S&P in 2022, it was a very difficult year. The index was down nearly 20%. It was its worst year since 2008. And then you also had the NASDAQ, which fell, more than 30%. That was also its worst year since 2008. When you look at the S&P 500, though, which is composed of 11 sectors, there were only 2 sectors that ended the year in the green, and that was utilities, which was just mostly flat. It was up like 1 or 2% for the year, which is a lot better than negative 19%, right, or 20% or whatever. But the big winner in 2022, the clear winner, was energy. Energy, had a great year, was up around 62% or so on the year. Now, let's talk about some of those top performers, and let's talk about some of the laggards. So when we look at the top performers, again, energy stocks were the clear winner of 2022. You have things like OIH ETF, which focuses upon energy services, oil services. That one was up 66% for the year. Just the general S&P 500 energy sector ETF XLE was up around 64%. So energy had a great year. In fact, at the very beginning of the year and throughout much of the year, our number one dividend aristocrat, we rank all of the dividend aristocrats. There's like 65 of them. These are companies that are in the United States that pay an increasing dividend for the last 25 years plus. Our number one dividend aristocrat throughout much of 2022 that we kept pounding the table on for our members was Chevron. And Chevron had a great year, up around 50% or so. So Chevron and just the energy space in general, what a really great year. Now, in addition to just the general energy space, we also had value stocks. They greatly outperformed growth stocks by the largest margin we've seen in 22 years or so. And over the last decade, especially since the 2008 crash, growth stocks have traditionally been, the ones that outperform. They've been outperforming value stocks for almost every year, especially through the pandemic. This was mainly due to low interest rates. But we saw that switch last year. So in 2022, we saw value stocks really outperform growth stocks. We also saw large cap stocks outperform small cap stocks last year. Usually small cap stocks are more attached to the domestic fortunes, the domestic economy, and they tend to be much more sensitive to, rising costs, especially inflation. Large cap companies are just able to handle that a bit better and pass it on to their to their customers easier. They have more pricing power. So small caps tend to underperform when you have a bear market or especially inflation, as I mentioned. So small caps really got hit. And then you also had volatility. So volatility was a big winner last year, up 26% in 2022. So if you didn't know where to go, many traders were just focused upon volatility. The U.S. dollar had a good year. It was up around 8% in 2022. And the U.S. dollar is still well positioned right now. And we saw that in 2021 and 2022, that the U.S. dollar still enjoys the crown. The U.S. debt is more attractive at higher rates. And we saw that. We saw inflows into the dollar, and we saw inflows also into some debt instruments as the rates went up. Also, not just the dollar and large cap stocks and volatility and value and energy, but we also had many countries, not many, we should say just some countries and some commodities that bucked the overall brutal downtrend in 2022. Thinking about things like Turkey, which is facing massive inflation. Nonetheless, its stock market rose more than 100% in 2022. And our ETF leaderboard, our members here have known about the uptrend in Turkey for some time. And we've been able to capture, more than 45% of that rally just over the last 10 weeks, with our ETF leaderboard. So our members have been happy about that. Brazil was up 12% in 2022. That's not too bad, considering. Argentina suffering, again, major inflation, worse than Turkey. That was up 12% in 2022. So it bucked, the overall downtrend. Then if you look at commodities like corn, for example, up 25%, soybeans up 25%. The commodities ETF that we like to track, DBC, that ETF was up around 19%. Platinum had it beat all the other precious metals in 2022. It was up nicely, around 10% or so. 11%. And then in addition to that, you also had some inverse ETFs that really worked. So we often talk about using inverse ETFs to make money in a down market. Well, two of them that really worked well were the ProShares S&P 500 short ETF, which was SH. That was up 18% in 2022. It did its job. It gave you the exact inverse mirror, return of the S&P. And then the other ProShares ETF that we like in that's for inverse is the PSQ. That is the inverse of the NASDAQ index. And that one was up more than 30% in 2022. So if you went inverse ETFs, if you looked at certain commodities, certain countries, the dollar, volatility, large cap stocks and value and energy, this is where you saw the better performance. Now, when we look at the underperformers or the poor performers in 2022, we see big tech stocks right there near the top of the list, right? So the big tech stocks just collapsed in 2022, mainly due to fears of recession, slowing economy, and this relentless increase in interest rates that the Fed had engaged in. If you look at some of the biggest U.S. tech stocks like Apple and Microsoft and NVIDIA and Meta Platforms, formerly known as Facebook, and Amazon, and all of these different companies, they lost collectively more than $4 trillion in market cap in 2022, right? And because those big tech names make up such a huge part of the major market indices like the S&P 500 or the NASDAQ, it really dragged down those indexes, sharply. And so it's just a really tough year for big tech stocks. And many of them now look pretty attractive. Like Google, for example, which I own, looks really attractive right now. I like the way that it looks. Apple has begun to come down. It's been one of the stubborn ones that's been holding on. So that's an interesting space. And then after enjoying their best year in history in 2021, REITs, which are real estate investment trusts, real estate, suffered a brutal sell-off in 2022. Again, because of those higher interest rates, which are not always good for real estate, and also fears of recession, which is never good for really any kind of industry. All things being equal, recessions are, we don't really want to see them. They're not always good. And of course, for real estate, it can be tough. Also, if you're looking for underperformers in 2022, don't forget long-term bonds. They were already in a major bubble, and we were talking about that bubble for years in bonds. But boy, did that bubble burst in 2022. Long-term bonds suffered their worst annual performance on record last year. Think about that. That's incredible. For example, the ETF TLT, which is a very popular ETF among bond investors and traders, which tracks the long-term bonds, those that are 20 years or more for maturity. TLT fell around 30%. So the long-term bonds, like the 30-year bond, down more than 25% in 2022, right? So the 60-40 portfolio that many financial advisors talk about, where you put 60% of your money in stocks and 40% in bonds, there was just no mercy. I mean, both stocks and bonds just cratered. Even the long-term bond, which you think, the 30-year bond, you would think that would give you some sort of protection in this kind of environment. Not at all, right? It just sunk. And many people got hurt because of that. But bonds were due for a big sell-off, right? They were definitely due for a big sell-off. Even Treasury inflation-protected securities, like what they call TIPS, which are designed to shield investors from inflation, those even fell double digits in 2022. And then, of course, we had cryptocurrency, which suffered a brutal year in 2022 after really having a banner year in 2021. And then in 2022, it was almost the mirror image, right? So very painful year for cryptocurrency. The largest cryptocurrency, Bitcoin, lost a lot of money in as far as value and market cap. It was declined around 65% last year. Much of that just due to the normal cycles of Bitcoin, based on its 4-year cycle that I've often talked about. But you also had the FTX collapse. You had the Terra Luna collapse. It was a brutal year and a brutal bear market for cryptocurrencies. We've been talking about cryptocurrencies a lot with our members lately because we believe, very near a bottom for Bitcoin. We may have more to say about that on a future podcast episode, but cryptocurrencies definitely suffered big time. You also saw, again, difficulties in the innovation space. Think of Cathie Wood and the ARK Invest funds, ARKK, down, like 67%. One of her top holdings was Tesla. That may explain it, because Tesla had a brutal year as well. Also, cannabis stocks, just got hammered. There was a lot of hope that there was going to be some sort of breakthrough for cannabis legislation in Washington, and of course that was delayed and didn't occur. Now, let's move on to the sectors, because let's break down the performance of different sectors. And when we look at what really worked last year, when you look at the 11 sectors of the S&P 500, you'll notice that the winners were all defensive sectors, and they were the relative outperformers in 2022. Energy, which we already talked about, had a banner year, one of its very best years we can see going back for some time. And then utilities, we mentioned utilities, which also did well. Healthcare and consumer staples, which are also what we would call defensive sectors. These are traditionally considered recession-proof sectors. They can tend to hold up better during times of an economic slowdown. And they're also considered sometimes inflation hedges, because people will, tend to buy consumer staples or pay for their utilities, or, they need healthcare no matter what. Even as prices are going up, they don't really have a choice. They have to buy food, they have to buy, electricity and power and water from their utilities, and they have to have healthcare. So even when those prices are going up, traditionally those companies can pass on. They have a lot of pricing power and they can pass that on. So in this environment, those did well. And by the way, our sector rotation strategy, which we have here at Follow the Money, we try to beat the S&P 500 through our own sector rotation strategy. So every 3 months, we alert our members to, what three sector ETFs we're going to be holding for that quarter. And we just released those for Q1. But last year for 2022, we really did well. We beat the S&P 500. The S&P 500 was down about 19.4%, and our goal is to beat it. Our sector rotation portfolio was still down. It was down about 3.3% for the year, but that's a lot better than losing 19.4. So we still beat the S&P 500, even though we were negative, just below zero. But we were heavily invested in energy, utilities, and healthcare and staples, kind of back and forth throughout the year. So that's working out. Now we have our latest picks for Q1, and again, we've recently put those out to our members. Now, when we think about some of the sectors that really underperformed, these were kind of obvious. It was consumer discretionary, which these are luxuries. These are things that are not consumer staples. These are consumer stocks that you don't necessarily have to go out and buy their products, right? And in fact, you may not. You think of near the top of that list as something like Amazon or Tesla. These were companies that really got hit last year. And so those types of companies in the consumer discretionary space were hit very, very hard. Also, communications. Communications was probably the worst performing sector. It was, in fact, the worst performing sector last year. Google was at the top of that list. Meta, which is formerly Facebook, they're at the top. Verizon and Walt Disney. These were companies that got, really hit hard in 2022. So it makes sense that those sectors came down. So the winners, energy, utilities, and healthcare and staples to an extent, as far as relative outperformers, and then consumer discretionary and communications and tech kind of being among the worst performers last year. Now, what's ahead for 2023? What are we going to see as we move forward? Well, this podcast is really not a market outlook. It's really a market recap. Earlier this week, though, I hosted a members-only video presentation where I shared several investment themes that I expect to outperform in 2023. And one area that I can share on this podcast episode that we expect to outperform in 2023 is precious metals. Gold, silver, and platinum are all looking very positive on their charts. and the fundamentals bode well, especially for platinum as we head into the new year. The World Platinum Investment Council said in its latest quarterly report that the global platinum market is expected to be in deficit in 2023. So it's had a couple of years now of being having surpluses, but now the global platinum demand is expected to rise by 17% this year, while supply is only going to raise by about 2%. So that's a recipe for higher prices for platinum. Also, if you look at gold, central banks are buying gold at the fastest pace in 55 years. There's a strong demand for real money, and gold is real money. Then you have silver, which is verging on a major technical breakout. That one also looks positive. So, I would say gold, silver, and platinum as we head into the new year are going to be potential bright spots. And there are a few other bright spots that we see as well. We've talked about those for our members. I'll be talking about some of those on future podcast episodes. But if you want to get the whole list and know exactly what we're focused upon as we head into 2023, I think there's going to be a lot of opportunities. You can become a member here at Follow the Money. Just go to followthemoney.com/join. Choose your plan. If you want our weekly coaching, I encourage you to do the gold or the platinum plan, because that'll give you access to our weekly live coaching where you can ask questions, learn about investing and trading, and bounce off ideas, and it's a really great time. So, but yeah, those are some of the areas that we expect to do well in 2023. I also mentioned China earlier, so I would say China and precious metals are two areas that we expect will probably be outperformers in 2023. In fact, I'm going to be joined by Tom Cloud, who is he's been a long time precious metals advisor, 40 plus years of advising clients. And he's been a sponsor here at Follow the Money for years, ever since we've been on the air. We're going to have Tom on an upcoming podcast episode this month to discuss precious metals more in depth. We'll kind of drill down into that platinum story and also talk about why gold and silver may make sense this year. In fact, we're also going to be conducting a free precious metals investing webinar later this month, and I'll have some details on that very soon. All right, friends, welcome back to the podcast. Great to have you here. So on today's episode, we took a retrospective look at the major trends and movements in the financial markets over the last tumultuous year. We analyzed the performance of key indices and identified some of the top performers and some of the laggards. We also broke down some of the performance of different sectors. Overall, the financial markets in 2022 were characterized by widespread declines in investor uncertainty. Many stocks, many bonds, many cryptos saw significant losses, and there were very few bright spots to be found. This current bear market has been driven by a combination of economic headwinds, such as rising interest rates and supply chain constraints, as well as market-specific factors, such as overvaluation in certain sectors and that bond bubble we talked about. But despite the last year's incredibly challenging market conditions, there were still opportunities for short-term traders who stuck to tried and true trading strategies. There were also opportunities for investors who were willing to take a long-term approach and carefully select their investments. Now, as we head into 2023, a lot is uncertain, but what is certain is that it will be important for savvy traders and investors to stay informed and to adapt to changing market conditions in order to navigate further potential downside in the first half of 2023, which could be ahead, so that they can emerge stronger on the other side. I want to encourage you, don't let fear or uncertainty hold you back right now. We've been through a brutal year, but instead I want you to embrace the challenge and trust in your ability to navigate through these difficult times. Remember that investing is a marathon, it's not a sprint, and the journey towards financial success requires patience, perseverance, and a positive attitude. So I encourage you to keep pushing forward. Don't let this last year deter you from your long-term investing goals. Don't forget that with hard work and determination, you can achieve your dreams and reach your full potential as an investor. So let me conclude by saying thank you for tuning in to our year in review of the tumultuous 2022 financial markets. And we hope you found the discussion informative and helpful. We look forward to bringing you more market analysis and insights in the future. And with that said, that brings us to the end of today's podcast episode. And as always, I like to leave you with a final word, this time spoken by one of the world's greatest investors, if not the greatest investor, Warren Buffett, when he said, "The stock market is a device for transferring money from the impatient to the patient." And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.